All right. Welcome everyone. Today we are going to talk about a video about why quantitative tightening from this video of the real reason the Fed just ended quantitative tightening. Now, the reason why I'm showing this video is because I watch these videos, and I'm going to do this a lot in this channel specifically, is I'm going to show you what I watch so I can stay informed. Now, everything that's said from this point forward has to be taken in a generalized sense. I can make some pretty solid predictions because I'm getting an overall picture because of all the information I know. Now, the whole purpose of this channel itself is I'm going to break it down so we all can understand it. But this Heresy Financial has a really good job when it comes to explaining it, but he can get into jargon a little bit. So when he starts doing that, I'm gonna break it down to how it affects us and how we can make it work within our own lives. Now, secondly is, some people are very divisive about politics. I have to say this up front just because politics is very divisive these days, but we must be at least very politically aware, which is my goal. Doesn't matter which side you're in, it's very important to be at least aware politically what's happening, because in almost all cases, it affects you whether you understand it or not. So let's get into this video and I'm gonna break it down a little bit.
Now that they have, here are a few things you should expect.
We'll start this
Federal
over.
Reserve has officially ended quantitative tightening, and now that they have, here are a few things you should expect are going to happen next over the coming months and quarters. This is a chart of the Federal Reserve's balance sheet. You can think of this like their brokerage account. When you have a brokerage account, you are going to buy and sell stocks with your brokerage account, which means whenever you make purchases, you're sending cash out into the financial system and you're receiving shares of the stock you're buying instead. This means that if you just look at you versus the entire rest of the financial system, the economy, every time you make a purchase, it's a liquidity injection. You're giving the economy your cash.
Yes. So just to break that down a little bit further, I think he did a great job explaining it, but I'm going to throw my 2 cents in here is even in real estate, I speak about this in my course. I'll start posting soon, but when you see in Zillow, for example, where a home is worth $400,000, when someone is listing a home for $400,000, what they're doing is, which is what we're talking about when it comes to stocks, is it's an ask. They want your $400,000 and you're going to get theoretically their home. So it's an even transaction. So what he's essentially saying here is money doesn't just disappear. When you trade in your money, your hard-earned value, you get something in return, which means you'll get stocks, you'll get the PS4, whatever that may be, and then the money will go out into the financial system. The only time money is actually created is when the Federal Reserve decides, oh, well, we're going to print more money than is already out in circulation.
But in exchange, you are receiving an asset. In your case, maybe it's a stock or an ETF. On the flip side, anytime you sell shares, you are giving the economy back those shares and you are withdrawing liquidity. You're taking cash away from the financial system. This is exactly what the Federal Reserve does with their balance sheet. Whenever they buy assets, they are injecting cash into the economy and they are receiving assets that they have withdrawn out of the economy. That process is called quantitative easing. And if you look back at their balance sheet here, anytime the chart is headed higher, it is quantitative easing. They're adding assets to their balance sheet in exchange for cash that they have injected into the economy. The only difference, and it's a pretty big difference between you and the Fed in this case, is they are creating the dollars out of thin air that they are using to make those purchases, which means anytime they are making purchases, it's actually increasing the net overall total liquidity and cash in the system. When you make a purchase, yes, the economy has more, but you have less. So anytime the Fed's balance sheet is going up, that is QE. They're creating cash and sucking assets away from the financial system. Now, anytime you see their balance sheet headed down, like in 2018 and ever since 2022, that is called quantitative tightening, because they are letting assets bleed off of their balance sheet, and then that cash disappears from the financial system. And
Yes. So he, once again, does a great job explaining it. I love this guy. He always constantly create these videos. So in this situation, when it comes to quantitative easing and quantitative tightening, the reason why I'm explaining this, because very soon you're going to hear it on the media. You're going to see it on social media, and these people are going to tell you things that are essentially fake news. They're going to try to lie so you don't understand what's really happening. So just to recap what he just said, quantitative easing is when the government or the Federal Reserve in this situation, because the government and the Federal Reserve are essentially the same thing, even though you're supposed to be separate, but they work together. The government, when it comes to quantitative easing, they are spending money. So what they're doing is they're buying two particular assets: mortgage-backed securities and treasuries. So the treasuries are United States government debt, and mortgage-backed securities are essentially mortgages, which was I can't remember exactly when it was, but when the Freddie Mae and Freddie Mac came in and the United States decided to back them, because at the time we wanted to spend more money, so the best way to do that is to allow financing, and banks were getting real stingy in financing when things were getting really tough. So what the bank said was, hey, I'll buy your mortgages so you don't have to hold them on your balance sheet, and then you can keep making more and more loans. So if the government is backing those mortgage-backed securities, if they default, it's not on the bank. So that's what quantitative easing, that's why when you hear quantitative easing, that's what they're doing. The banks are selling their assets to the Federal Reserve. They're buying it with the cash they just printed. And this is where inflation comes from.
This is because the assets the Fed holds are debt assets. So as that debt gets paid back, what the Fed does with those dollars that get paid back to them, some of them just cease to exist and they get destroyed. So QE, the balance sheet of the Fed is rising, and the cash in the financial system is rising. QT, the balance sheet is declining, and the cash in the financial system is declining. As of December 1st, 2025, QT has officially ended, which means their balance sheet will no longer be headed down like it has been for the past couple of years. Instead, it will start moving sideways like it did from about the beginning of 2015 through the end of 2017. Now, there's a very specific reason why they are doing this, and it's not what you think. It's not because we have a financial crisis right around the corner. It's not even because we have a liquidity crisis right around the corner. A lot of people recently have been talking about the reverse repo facility at the Fed and how that has hit zero, which means we're about to have another liquidity.
Really quick, the reverse repo facility, when he talks about this, is essentially the government's checking account. So you have the Federal Reserve and you have the federal government. So the Federal Reserve is the mortgage-backed securities and the Treasury bills, but the government's bank account, they have, or in this situation, it's essentially called the savings account, essentially a savings account for the United States government. The checking account is used to pay their bills, but this is specifically a savings account. So they use this when the government wants to take money out of the financial system. And when they do that, they give them an interest rate. So you see in 2022 and 2023, that was when inflation was really high. So the way they stopped it was, hey, banks, instead of you lending out the money, hey, give it to us. We'll give you a guaranteed interest rate, which we never get. They're essentially like the borrower of last resort. I think at one point they were getting like 3.5% on their money. So you get 3.5%, and you don't, and essentially that money isn't in the financial system anymore. It's completely out of it, which is what they wanted.
Crisis. But if you zoom out on this chart back to the early 2000s, you can see in normal conditions, the reverse repo facility of the Fed is not tapped. It briefly for a few years was used quite extensively as an overflow for the excess liquidity in the financial system that happened from all the money printing in 2020. But because of the Fed's QT over the last couple of years, all that liquidity has been drained from the system and we no longer have excess liquidity. But the removal of excess liquidity from the financial system doesn't mean that we are about to face a a shortage of liquidity or a crisis there. And in response to that, a lot of people show you this chart, which is the regular repo facility at the Fed, which is where banks and financial institutions go when they cannot get enough cash from each other. And they'll show you dates like October 31st and December 1st when financial institutions tap the Federal Reserve for emergency liquidity. They'll point to that as a sign of a liquidity crisis or a financial crisis, banks about to fail right around the corner. But the problem is, what they're showing you is the fact that we don't actually have a crisis right around the corner here, because if you look at this chart, they're getting the liquidity they need from the Fed themselves. This is something that the Fed established during 2020, their standing repo facility, so that we wouldn't have any sort of an acute liquidity crisis where banks would be at risk of toppling over just because they can't access the overnight funds that they need from each other.
Yeah, that's what happened in COVID. When you hear the Silicon Valley Bank, the problem with them was they when you hear about a bank run happens when people want to take all their money out because they lend out all the money. And the issue that they had was they couldn't get the money to essentially give the deposits to the people. And once you don't have the money, you have to sell bonds, which is what happened in Silicon Valley. Now you have to sell the assets to get the cash. And then as you sell assets, it drops the price down. And as it drops the price down, well, that's when you go bankrupt. So they established this so that doesn't happen again. But once again, they're the ones benefiting from printing all the money. We don't get access to it, but we have to deal with the consequences of higher prices.
So now, any amount that banks need overnight, they can just get that from the Fed. And when you have an unlimited liquidity source that you can tap at any moment, you're not going to run into a liquidity crisis that's going to knock banks over. So that is not the reason the Fed has ended QT either. And the reason we know this is because the way the Fed has ended QT is actually a mix of continuing QT in some areas and actually starting up QE again in other areas. If we look at the Federal Reserve's implementation notes from their last FOMC meeting, we can see they announced their plan to end quantitative tightening here, where they said that on December 1st, they would just roll over at auction all principal payments from the Federal Reserve's holdings of Treasury securities, which means anything that the government pays back to the Fed when that debt matures and the government has to pay that debt back, any of that that's held at the Fed, as that money gets paid back, the Fed says we're just going to take all that cash, just go right back out and purchase another Treasury security. We're just rolling it right back over. And so the amount that the U.S. government owes to the Fed would remain the same. This makes borrowing for the government a little bit easier than it's been previously, because previously, when the government would pay back what it owed to the Federal Reserve, they wouldn't be able to get all of that as new borrowing from the Federal Reserve. They would have to go find a new borrower instead.
And this is what's been happening, if you've heard in the grapevine the past year or so. Because our national debt is so high, they will have to do, when you're selling Treasury bonds, they are at auction. That's what it is. You're essentially collateralizing U.S. debt. And someone has to buy that debt. Now we have, like, Japan likes to buy the debt. Japan normally buys quite a bit of debt because of their financial situation, but you have to sell, you have to find a buyer. It's the same thing when I talk about real estate. It doesn't change. When you are trying to sell something, doesn't matter what it is, you must find a willing and able buyer who's willing to pay what you're asking for whatever you're trying to give or sell. If people don't want it, and this is what's happening by the United States government couldn't find people to buy their bonds at the interest rates they wanted. All the people around the world were saying, hey, you want to give us 4%. Well, we want 5.5% now because you're too risky. And the government at that point was trying to be real hard to get. So what they've been doing is they've been investing in the short term. U.S. bonds are normally around 30 years, depending on what the bond you have. But Treasury bills are up to a year, and I'm pretty sure he'll talk about it. It's what's we've been happening the past 3 years, that every time you're hearing about a U.S. debt and it being rolled over, they keep rolling over on short-term Treasury bills in hopes that if they lower interest rates, then they'll buy the long-term bills. But long-term bonds, which is why Donald Trump is fighting so hard to get the interest rate to be lower, because there's about $9 trillion coming up that needs to be refinanced, and he wants lower interest rates so he can go into the long end, because the short end, as great as it is very risky, because it can be affected by short-term problems. So if, for example, someone goes bankrupt and now they need to get the cash right now, well, if you're borrowing at the short end, you most likely might have to pay that much higher interest in that time of volatility, as it's called.
Because some of that the Fed would not be rolling over. It'd be like if you had a Treasury and it was a 10-year Treasury and finally your 10 years was up, government pays you back and they said, hey, would you like to reinvest and buy another 10-year bond? And you would say, no, not really. I just want to keep the money this time. The government's going to go have to find somebody else to borrow from because they're not running a surplus. They are borrowing everything they need to pay back everything that matures, plus more to pay all of their bills for the deficit that they're spending. So for the last couple of years, all that money they paid back to the Fed, they've had to find new borrowers to replace the Fed. Starting on December 1st, that is no longer happening. It's making government borrowing a little bit easier. But remember how I just said the way the Fed is ending QT is continuing QT in some areas and actually starting QE in other areas? We have to take a look at this next note from the implementation notes from their last meeting where they said beginning on December 1st, they will reinvest all principal payments from the Fed's holdings of agency securities into Treasury bills. Because remember, the Federal Reserve holds two types of assets. They hold Treasury securities, which is debt that the government owes to the Fed. But they also hold a bunch of mortgage-backed securities, which means there's a very good chance when you're paying your mortgage, or if you pay it off early, that money is making its way to the Federal Reserve. And for the last couple of years, the Federal Reserve has also been selling those off and letting those roll off their balance sheet. As of December 1st, they will still be doing that. Their holdings of mortgage-backed securities will continue to decline. And when they get paid back, they will take that cash and put it instead into Treasury bills, which means they will continue sucking liquidity out of the mortgage market, and instead they're just injecting it into the broader economy by loaning it to the US government and making the US government's borrowing easier. So this is continued QT specifically for mortgage-backed securities and increased easing that'll have a broader effect everywhere else. It'll keep short-term interest rates down and it'll make government borrowing easier and cheaper. So the effect of this is actually QE for treasuries and QT for mortgages. In this way, the Fed can keep their balance sheet steady, which means for the average person, if they do look into this and they figure out, oh, I can look at the Fed's balance sheet, and they go look and see it's just moving sideways, they'll be like, well, the Fed's not injecting liquidity. And technically overall that will be true. But what's happening behind the scenes is they're sucking more money out of mortgages and handing it to the US government instead. So
this is what's so important. That right there is probably one of the most important things of this video. It's that they will obfuscate everything they say so they can keep doing the things they've been getting away with. So yes, next year they're going to say, oh, we're not quantitative easing no more. But they are. The effect, and he'll go into this, the effect of them doing this is mortgage-backed securities. There will be so much more mortgage-backed securities because they are letting them go and letting them bleed off the balance sheet. So there will be more mortgage-backed securities in the market, and with people getting laid off, the risk of defaults go up so much more. Now, mortgage-backed securities of the people who buy them, because you have to remember, the banks aren't going to lend if they can't sell the mortgage-backed security immediately. That's how they make their money. So the investors who invest in MBSs, they're going to want a higher interest rate. And when they want a higher interest rate because the risk is higher, because people aren't paying it back, that's when we have to pay more for our home loans. And I honestly believe that's what the effect we're going to have. Our interest rates for mortgages are going to go up because since they're bleeding off the balance sheet, there is one massive buyer who isn't buying mortgage-backed securities anymore. So now the private market is going to have to take that in consideration, which is going to up the risk. And when risk goes up, that means the return must be higher for those investors to invest.
So QT for mortgages, QE for the government. Now, the next couple of things you're going to see happen over the coming months and quarters show us what the true reason is for the Fed ending QT here. The first thing that you should expect over the coming months and quarters is a drop in short-term interest rates. As of the time of this recording, the odds of an interest rate cut at the Fed's next meeting, 87%. And this will continue throughout 2026. And the primary reason for this is not the incoming economic data. The primary reason for this is leadership change at the Fed. Powell's term is up in 2026. Ever since Trump got elected, there has been massive pressure he's been putting on Powell to lower rates, and the leadership overall at the Fed has started to change as well. Specifically, one of the new governors of the Federal Reserve just wrote a paper and gave a speech on the regulatory dominance of the Federal Reserve's balance sheet. I made an entire video about this, but just to summarize, the entire speech was dedicated to showing why the Federal Reserve needs to deregulate the banks. And the subtext, reading between the lines, is because it will let the banks do quantitative easing for the Fed. Given what happened in 2020 and 2021 and all the inflation that unleashed, it would be extremely politically unpopular for the Fed to just actually restart QE again. For the Fed's balance sheet to start rising, everybody would be looking at that and saying, hey, we don't like this and we don't want this. And so instead, what they are likely to do through the leadership changes that are going to happen at the Fed over the coming months and quarters is allow the banks to buy an unlimited number of treasuries. Right now, banks are limited in how many treasuries they can buy. In other words, how much money they can loan to the US government by their risk ratios. It's called the supplementary leverage ratio. But given the fact, like we discussed earlier, banks can always tap the Fed for any liquidity that they need. Even if the treasuries they own are at a loss, there's another facility that the Fed has used before that allows banks to temporarily sell treasuries to the Fed at full price, which means that treasuries are now functionally fungible with reserves. And if that sentence sounds like Greek, I know it was stupid. Basically what it means is that if the banks hold treasuries, they don't have to worry about losses. There are multiple ways that the Fed has laid out that banks don't have to deal with realized losses on treasuries.
Basically, how he's explaining, and I'll explain it to our audience. Basically, it's when think of it like your equity in your home. When your home goes down in value, people get stuck in their home, just like in cars. If your equity is dropped below how much your car is worth, that means you're underwater. Now imagine the banks being underwater in their treasuries. Well, if you were to sell them, you would have to take what's called a realized loss. That's what he means by unrealized losses. A realized loss, if you sold it, you did the transaction, which in tax terms is called a taxable event, and now you have to realize the loss. See, the banks can give their loss, their underwater treasuries to the Fed, and they will pay for it full price. And the only stipulation is 1 year later, you have to buy it back. So, as he just mentioned, functionally, they can print an unlimited amount of money since they are already backed behind the Fed. So they have essentially two safety nets. They're backed by the Fed through the US Treasuries, but because they're limited on how much treasuries they can buy, this is why they're saying we got to deregulate the banks. This is why Donald Trump said we have to deregulate the banks, because it will allow the Federal Reserve to not print anymore. And when they're not printing anymore, guess what they can write on the news? Oh, we're not printing anymore. No inflation. When ultimately the inflation is coming from JP Morgan and Bank of America and Wells Fargo. They are the new money printers. For the fact that they can buy an unlimited number of treasuries. So that's the hidden damage that people are doing through politics. This is why it's so important to be politically aware, and the reason why I create this channel in the first place, just so I can explain that they're taking advantage of you, whether you understand it or not. They are taking advantage of you, so you have to stay a step ahead of them.
Which means that to a bank, it operates like reserves for them. And so the argument is they shouldn't be limited in how many treasuries they can buy, which makes sense, but it also means that banks can do QE for the Fed, which means banks can loan an unlimited number of dollars to the government, and the Fed doesn't have to do it themselves. And the reason why this is necessary is because while the Fed is lowering short-term rates, long-term rates are actually going up. This is a chart of the 10-year yield on the US government Treasury bond going back to 2020. And you can see for a while, the 10-year Treasury yield was extremely low. And obviously when the Fed started hiking rates as a result of all the inflation they unleashed, the 10-year yield also skyrocketed. But the bottoms in yield have continued to rise, just like the highs in the 10-year yield have continued to fall. Compare that with short-term interest rates, which have only fallen as the Fed has been cutting. In other words, as the Fed cuts, the yield curve is steepening. And that is a direct result of the market pricing in higher future expectations of inflation.
This is why it's important to understand finance, because with all the data, the market, this is why they call it market sentiment, how the market feels, is that these investors are already planning for higher inflation. Now, they can be wrong, of course, but this is why that there's a few people who know me, I've constantly said we're going to experience high inflation in the next couple of years because how much in debt we're in. They are going to print endlessly until they can devalue the debt, even though it's not going to work. It's just going to make we're going to feel the real pain of it. But that's why they keep doing this, is because it allows them to cover their butts. That's what they want. So now we're in this situation where we gotta have to find a way to deal with it ourselves and not take the brunt of all this pain that's about to come down.
Just think about it. If the government has the ability to borrow more and spend more easily, and the money they're borrowing and spending is being printed into existence, that is a rising pressure on prices. If you as a lender knows that prices will be higher in the future, you will demand a higher interest rate on your loan to compensate you for the loss of purchasing power along the way. Which means the more downward pressure we get on rates at the short end for things like T-bills and the Fed funds rate, the higher those longer term rates are going to go. But the entire push for this, especially by the government, is to get their borrowing rates lower, not higher. But it's having the opposite effect. And the only way you can fix this is with quantitative easing, which we've already discussed would be very unpopular for the Fed to outright do, which is why they're doing it through a twist on their balance sheet. They're selling mortgage-backed securities, using that to roll over to T-bills. So they have to do it secretly behind the scenes. They can't do it outright. Or they could do yield curve control, which again would be quantitative easing, because yield curve control, they have to add bonds to their balance sheet. And so they're pushing the banks, or they're going to allow the banks to do it instead through deregulation. And this is the real reason behind why we're seeing QT end now, why we're seeing rates lowered into the future, and why we're seeing the push to deregulate the banks. It is because the government needs it. They need an ever-expanding base of newly created money to borrow into existence so that they can spend and afford to do so. If nothing changed from here and everything stayed the same in terms of the Fed's balance sheet, the bank's balance sheets, interest rates, that would eventually push the government over into default. There's not enough money for them to continue spending the way they are. They need an ever-expanding money supply to continue to tap. And that is the true reason behind what's going on right now. And you can see this directly by looking at the Federal Reserve Reform Act of 1977. I always say that it's Congress that controls the Fed, not the other way around, and everybody loses their minds because they love the conspiracy and love the fact that the Fed started as an independent private institution. But anything only exists as long as the monopoly on violence wants it to exist, and the only way the monopoly on violence wants it to continue to exist is if it serves their purposes. The fact of the matter is the Federal Reserve could be shut down tomorrow if Congress actually wanted it, but instead they gave them a triple mandate.
Yes, this what you're about to say is so important. You need to understand what the Federal Reserve's job is. And he's going to say something I believe is so profound, because most people aren't aware of what their true mandate is. So I'm gonna let him finish it.
One job through 3 roles to force them to only do things that serves the government. We can see in section 2A on the first page, it says, the Board of Governors of the Federal Reserve System and the Federal Open Market Committee shall maintain long-run growth of the monetary and credit aggregates commensurate with the economy's long-run potential to increase production. The thing the Federal Reserve must do is expand the money supply. That's what monetary and credit aggregates means expand the money supply along with the growth in the economy. That's what commensurate with the economy's long-run potential to increase production means. If the economy grows, expand the money supply along with it, so that any increase in wealth does not show up in cost of living going down for individuals like it did for all of human history. Instead, that increase in productive capacity will be soaked up by the government through a debasement of the currency, through loss of purchasing power. If the pizza grows, cut more slices into it so that each slice never actually has more pizza. And where do all those extra slices go? You guessed it, to the government's ever-expanding appetite for borrowing and taxing. And we know that because it says in the amendment, the way to achieve that is with maximum employment, stable prices, and moderate long-term interest rates. What does maximum employment actually mean? It means the maximum total tax base. The more people who have jobs and the longer they must have jobs means the more the government can tax people. So maximum employment is not about wealth. It's not about individuals getting a better life. Maximum employment is about maximizing the tax base. The second mandate, stable prices. Left alone, prices go down. When you measure the real cost in terms of hourly work that a human has to do in order to achieve basic necessities or even luxuries throughout all of human history, it gets cheaper. We need much less human labor to get food, shelter, clothing, transportation, and entertainment than we did even 50 years ago, 100 years ago, 5,000 years ago. Prices, in real terms, go down as we discover new ways to make things more efficiently. That's what growth is. It's getting more for less. But if you can make sure you print money enough to make sure prices don't ever go down, then number one, you increase your tax base because everybody's incomes keep on going up. It's no accident that the Federal Reserve was established the same year as the individual income tax. If prices continue to go up, wages continue to go up, you get to tax everybody more and more and more and more. But it's also to decrease the debt load because we know that inflation helps the borrower and hurts the lender. Because as the value of those dollars goes down, you get to pay back dollars that were easier to get than the dollars you originally borrowed and spent. In other words, you borrow something of higher value, pay something back of lesser value. So the stable prices mandate allows the government to maximize their tax base and decrease their real debt load. And third mandate of moderate long-term interest rates is very self-explanatory. Make sure long-term interest rates never get too high because that's what the government relies on to borrow. And that, again, is everything that we're talking about today. Why quantitative tightening is ending, why quantitative tightening for mortgages is continuing, and quantitative easing for T-bills is starting, and bank deregulation is being talked about. Short-term interest rate cuts are on the horizon and happening, all in order to make sure that long-term interest rates stay moderate, which is up to interpretation. And the interpretation is always that the government continues to borrow and spend whatever they want. And that is the reason why we're seeing everything we are seeing right now.
Yes. That's basically the end of the video. That's basically the point I wanted to get. That's the reason why they're doing everything they're doing. All of it is based on the government being able to monopolize all the wealth creation so they can spend more. This is why it's so important to stay informed as a populace, because it's our job to keep them accountable. But unfortunately, there's too many of us who are ignorant about things like this that they can just get away with it. And that's exactly what's happening. They're going to say, well, the Federal Reserve isn't printing no more. And guess what? They are printing. You just don't know how they're doing it. And this entire channel is about explaining this so we can change our lives so we can benefit and not get destroyed because they want to be so ultimately greedy. So that's essentially the end of the video, and I will see you next time.